So it's a pleasure here to discuss this paper, Central Banking with Many Voices, the Communications Arms Race. This is a thought-provoking paper. It's not often you get to discuss arms, weapons races at an economic conference, forget at a central banking conference. And this is quite an incendiary paper in a number of ways, not just the title, not just the phrasing of this as an arms race, but my initial reaction reading this paper was, wow, there's some themes throughout this paper that describe a very different world than my priors, or at least how I used to think central banking work. One set of themes that is quite different than my priors was the importance of leaks. Running throughout this paper is an assumption that leaks happen regularly. Maybe not quite day-to-day operations, but that leaks are part of the central banking process. And at least my experience when I was on the MPC at the Bank of England was not that. We did not worry about leaks. We did not talk about leaks. There was not a concern about leaks. And at least I never saw anything. So my initial reaction was, okay, was I just too honest and I didn't see what was going on? So then I went on the website at the Bank of England and tried to do some searching through the public documents to see if there was any sort of track record of concerns about leaks or leaks happening. And what I found is one incident of a leak in 1989 when the letter from the governor to the chancellor part of it had been leaked in advance. And then the only prior incident of a leak was 1977 that was discussed. There was the term leak used quite a bit, but it was about macroprudential policy leaking over to other sides of the financial sector or things like that. So really only 2 cases of leaks talked about in public documents. Then I went to the website for a couple other central banks. So this was not as thorough a search as Annette did. I'm sure there are other documents out there, but at least what I could find quickly in a couple hours on the web, I found that Reserve Bank of New Zealand, there was a problem of a leak that happened a few years ago that was publicly known and there were legal proceedings, but didn't find evidence of widespread leaks as discussed in this paper. But then once you read the paper, Annette has some very convincing evidence that this does happen quite a bit in the US system. So that does raise quite a bit of questions about why in the US Fed do we have these problems with leaks? What is it about this institutional structure? It also brought back memories of another job I had before I did a stint as a central banker when I worked in the White House on the Council of Economic Advisors. And that was an environment where leaks were often more common. I remember there was an ongoing joke at the White House. In the morning meeting, we'd all read the newspaper, not to get the news, but to see who leaked the night before. So again, it did make you think quite seriously about why are some institutions more prone to leaks and others not as much. Then the other theme throughout this paper that really made me take a step back and think was it implies that some central bankers are really quite strategic and underhanded. Annette describes a world where central bankers don't just make a mistake and sometimes say something that they shouldn't have said, but they conscientiously leak confidential information to try to get a strategic advantage and beat out other central bankers with their policy choice. Once again, that was quite different than the world I experienced, at least when I was a central banker. I thought it was much more collegial, much more having debates out in public. I couldn't imagine this sort of underhanded, deceitful game going on. And once again, it made me take a step back and think, am I too honest? Am I too trusting? But when you think about it, if this world is playing out the way described in this paper, you're talking about people who are not only dishonest and maybe immoral, but they're undermining the institution that they're part of, and they're breaking the law. If they are taking information from confidential documents and sharing that with the press and market investors, that is another whole ballgame of breaking the law where there's legal implications of this. So once again, this is a paper that I think is going to make people really take a step back and think about what is going on. And especially, even if you don't fully buy all the arguments, think about institutional structure that could support this type of system. So before I get to that, though, in the policy responses, what I'm going to do for my comments is first, super quick overview of the paper. It's a pretty straightforward set of arguments and model. Then I want to take a step back and think about, does this really happen? And focus on 2 lines of the argument where I'd like to see some more evidence. First are the key channels operative, and then some more evidence on exactly who is leaking and for what purpose. And then I'll talk about the policy responses. So first, just super quick overview of the paper. So The main idea encapsulated in this paper is that FOMC policymakers seek to push outcomes toward their preferences, and they do that by influencing market expectations through leaks and informal communication. And once these leaks get out there, it moves the markets, and then the FOMC options become more restricted because they don't want to make a decision that goes in a different direction than the markets. Then they're being seen as being less predictable. And with sufficient disagreement, and that shows how you can end up in a sort of prisoner's dilemma, where the outcome with everyone leaking is worse than if no one leaked at all in the first place. She used this great term, quiet cacophony, to describe this leaking and this informal communication that is going on and that leads to these suboptimal outcomes in terms of less policy flexibility and lower welfare in the end. So overall, the argument is pretty straightforward at a high level. If you work through the math in the model, it's pretty straightforward. It's one of these models where initially I said, oh, do we really need to use some Greek letters to write all this down? It's pretty intuitive. But then when you actually work through the model and go through the math, there are some subtleties that come out that have some nice testable implications that I think are worth working through and could actually lead to some more empirical work to try to flesh out a bit more if this is actually happening. So the model, again, pretty straightforward, no disagreements and quibbles. If anything, I'd just like to see the formal model used to push the empirical work a little bit more. But then, does this hold? Is this valid in the real world? Moving from the model, which again makes a lot of intuitive sense, to actually how monetary policy is set. So the key channel underlying this whole model is that the Fed doesn't want to surprise markets. And that is why the Fed becomes constrained. If people leak, markets move in a certain direction, then they can't do what might be the optimal policy when they're actually meeting. So does that hold? So to just get a sniff test if this holds, I thought back to the 3 years I was studying monetary policy at the Bank of England. Were there times when we were influenced by market expectations and market moves, and times that might have pushed us to make a decision other than what we would have otherwise made? When I summarize sort of where we stood, let me just say I'm using the term we very loosely. The MPC at the Bank of England was 9 people, different views, different opinions. There were some who cared a lot more about markets, some who cared not at all, as often happens on committees. So when I talk about sort of where we were, this is sort of where the median voter was, or where the emphasis of the discussion was. Again, there's always different views. Okay, so how much did we care at the Bank of England about surprising markets? How much of a constraint was that on our decisions? So there was one period when where the market was did really factor into our discussions. That was when we talked about the first rate hike after a period where rates had been basically at the effective lower bound and hadn't moved in almost a decade. So when we're talking about liftoff, that first move, when we're talking about a generation of young savers and borrowers who might have never seen interest rates go up, that's when we really were cautious, and we didn't want to surprise markets or act in a way that was not expected, just given how long there'd been a period of no action, basically, or no raising of interest rates. So I don't think there was ever a period we didn't do what we thought we should have done because of market expectations, but that was when talking about preparing the market was more important and not being out of sync with market expectations. But other than that one period, most other periods, market expectations didn't feel like very much of a constraint. For example, there were some periods where we were under a strong forward guidance, where we basically said nothing is going to happen for an extended period or until certain hurdles are met. In those periods, market moves really were not an important factor in our discussions. Then there were some other periods we wanted to shift to being data dependent, where we didn't want to give guidance, we didn't want to give signals, we wanted to have each meeting live and make the decision at that meeting based on the most recent data. In those periods, again, I don't think market expectations were a big constraint on any actual decisions being taken. And then there were some other periods when there was discussions of easing, when actually surprising markets was seen as a good thing, not a bad thing. So think about if you need to provide stimulus, and markets already are building some in, you almost want to come out and surprise markets by providing more. And that was part of the debate after the Brexit vote in June of 2016. the MPC, or August 2016 when we met, the majority in the committee wanted to provide a stimulus to support the UK economy as this period of heightened uncertainty after the Brexit vote was occurring. And markets were then largely pricing in these two things in green: a reduction in our bank rate, interest rates, by about 25 basis points, and markets were pricing in that the MPC would do some sort of stimulus through additional QE of government bonds, but we wanted to make sure we not only delivered what the market expected, but more. And so in the final package, we also delivered a new QE program of buying corporate bonds and a new special program that subsidized lending to banks. So that was a time where this channel of not wanting to surprise markets did not apply at all. If anything, we wanted to surprise markets even more and deliver more stimulus than provided in the markets. So again, not constrained. Another problem I have with this idea that the central banks don't like to ever surprise markets and that will constrain their decisions is if there is a period where market expectations are off, where the committee thinks they should be going, or especially the chair thinks you should be going, it's pretty straightforward to just message right ahead of time and try to get expectations back in line of where you think you'll be going. A great example of that just happened a couple days ago when John Williams gave a talk to a group of central bankers at an economics conference, and his talk was interpreted as signaling the Fed would lower by 50 basis points at their next meeting. Markets moved in that direction. The Fed was watching, and that it sounds like that is not where they are. So very quickly, within hours, a Fed spokesman came back out and clarified the message from Williams' speech and basically said, we are not signaling a 50 basis point reduction, and markets got that message and they moved back. So given that you can adjust messaging if the markets seem to be getting too far off, I'm again not sure how much of a constraint it actually is for people when they sit down in that room if the market's off by a bit. If you really are worried about that, you can adjust in your messaging ahead of time. So at least that's my view, or where I wonder if this mechanism is really that strong. But I think to be more convincing, the paper could push the empirics a bit more. For example, if you think leaks are aimed at pushing the market in a direction to constrain central bankers, are there more leaks around easing than tightening to see when this channel might be more important? Or are there more leaks when there's a closer decision or more disagreement, when market moves might be more important in terms of what actions are taken? That's something you can test empirically to try to get a little more sense of if this channel's at play. The second key assumption underlying this framework is about who leaks. So this discussion in the paper is actually quite interesting for someone who hasn't read this literature. I urge you to read it. Great terms to describe the different motivations for people to leak. The paper focuses on one set of leaks for policy reasons. Basically, people want to leak in order to push their view forward, their more hawkish view or their more dovish view, or you counter-leak to counter someone who's leaked in the opposite direction. But there's another whole set of reasons why people leak. And when I think back to the time I was in the White House, my experience was some people might leak for policy reasons, but most of the people who leaked were actually people who were not in the room at the big meetings. Those are people who often were not in the know, but they wanted to try to show that they were important or act like they had inside information. So my experience was more the leaks were more ego leaks, trying to build up your self-importance and trying to act like you knew what was going on, or goodwill leaks, where people wanted to curry favor with reporters to then have reporters cover them more positively. And I definitely saw some of that going on. But those are very different reasons to leak, which wouldn't fit in with the story in the model outlined in the paper. If the people leaking are more junior people who want to sound important, or people who don't have much impact on the actual policy moves, or people who just want to get on well with reporters, that's much less of a concern than people actually trying to shift policy and restrain the Fed's policy. So that's, again, another sort of set of tests that I think you could do empirically. Are most of these leaks around controversial decisions? Do they shift markets? I think that's something you could, again, flesh out a bit more with the empirics. and to better understand why these leaks are happening. And also, if you go through the very detailed descriptions of who's leaking and where they happen, it does seem like there is a pattern there. Some of the leaks appear to be more junior people, more are Fed presidents. It's not clear many of the leaks are actually happening by the board members based in Washington. So that also leads to some really interesting implications for how you resolve this, if you think this is a problem. So that's the last part of the paper I want to talk about, is policy responses. So let's say we buy the story. Let's say we think that FOMC members do regularly leak in order to get an advantage and push policy in a push markets in a certain direction to then get policy to go in the direction they want. What do you do about it? Again, assuming that the mechanism does hold. So I firmly agree with Annette's recommendations on what not to do. One suggestion is just put a lot of people who think the same way on the board and who all agree, and then you won't need to leak. I strongly disagree. Getting different views, different backgrounds is incredibly important when setting monetary policy. There's no right and wrong. You need the different views, and it's healthy to have those different views out there. Another possible suggestion is have people disclosing preferences in real time. Everything's out there all the time, then there's no need to leak. I also agree with her that doesn't make a lot of sense. You don't want people responding to each data, changing their position. There will then be such a cacophony, no one will listen to anything. So agree, that's not the way forward. But Annette then had 3 suggestions she thought did make more sense. One was better communication. It's hard to argue against better communication. There's spent a lot of time yesterday talking about better communication. I hit a bunch of examples of better communication from the Bank of England, but we talked about that so much yesterday. I just show you other banks are doing it. Here's an example of the Reserve Bank of New Zealand's attempts to communicate better with the general public and part of the public that doesn't usually follow central bankings. Sort of simple pictures, simple phrases. And then some central banks are trying to make central banking more fun. And there's some great rap videos. If we don't have much Q&A, I'll play some of these. But in Russia, there's the head of the central bank in a video singing. My absolute favorite is the Norge Bank has these men throwing cod around with a rap by DJ Codfather to talk about their new note that has a cod on the front. I mean, they're really catchy videos. So this communication, I think, makes a lot of sense. It's getting different people involved in central banking. It's drawing more attention. But I'm not sure that this is going to solve the problem that Annette's focused on. The people who are market investors, who these leaks are aiming to affect, are not reading this sort of stuff or watching these videos. These people are actually reading the inflation reports in the minutes, in the detailed forecasts. So again, better communication is good, no arguments with that, but I'm not sure that's really going to get at some of the issues that are in this paper. Then there's a second set of arguments, and that didn't talk so much about today, but where I have quite a different view. One suggestion is just have the Fed the chair take more ownership of communications. Don't let all the other people speak as much. Have the Fed chair speak more. That's the voice of communication. I actually think that would be a step in the wrong direction. I think it's useful to have different voting members, different governors speak, express their views publicly, and if they can do that freely, then there's not a need to leak and do everything informally. By empowering the individuals on a committee, you should have less need for these illicit games under the tables. A good example of that was at the Bank of England, where there's 9 members, and there's a culture that everyone's supposed to have their own view, express their view publicly, give speeches defending their view, and testify in front of Parliament regularly to have your view. And you often vote in a dissent. This shows over time at the Bank of England how many dissents there were. And it's not only external members dissenting, but it's internal members, deputy governors voting against governors. The governor, the yellow there, is even outvoted on occasion. I think this sort of culture of everyone expressing their views, active dissent, makes it less likely you'll have the need to do the informal, illicit leaking. So that's one area I have a slightly different take. But then for that to work, to have each member out there publicly expressing views, showing that sometimes monetary policy decisions are not straightforward and there's different factors to be brought in, that is hard when you have 19 people doing it. And that's where I think Annette's final suggestions that you probably do need to find ways to make a committee smaller to make this work and hopefully discourage this sort of informal communication could make some sense. So the bottom line from all that, I think this is a really fun paper, very thought-provoking paper. It's worth a read to really have you think about how central bankers behave. But I do think more evidence is needed on the extent to which market expectations affect decisions and why leaks occur in certain places and in what institutional structures. But whether you fully agree the mechanism outlined in the paper or not, I think the paper overall is very important to think about what is the optimal structure for central banks. This is something there's a very active work on right now, and this is an important paper to feed into this debate. Thank you.